Let's explore the third step of IFRS 15 in detail. Determine the transaction price. In step 3, XYZ Electronics needs to determine the transaction price, which is the amount of consideration it expects to receive in exchange for fulfilling its promises to the customer. This step may involve some complexities, especially when the transaction price includes variable considerations, discounts, or non-cash considerations. Key aspects in determining the transaction price. Number 1. Fixed consideration. You start by considering the fixed amounts that are explicitly stated in the contract. These are amounts that XYZ Electronics expect to receive with a high degree of certainty. In the contract, the base price of the smartphone is $500 and the customer is expected to pay this amount. Number 2. Variable consideration. Variable consideration includes amount that may change based on factors such as discounts, rebates, bonuses, or performance-based incentives. XYZ Electronics need to estimate the variable consideration subject to certain constraints. Example: if the contract includes a potential $50 rebate if the customer refers a friend, XYZ Electronics would estimate the likelihood of the customer referring a friend and adjust the transaction price accordingly. Number 3. Time value of money. If there is a significant financing component, XYZ Electronics must adjust the transaction price for the time value of money. This occurs when payment terms allow the customer to pay significantly later than the time of delivery. Example: if XYZ Electronics offers customer a deferred payment option with interest, they need to adjust the transaction price to reflect the time value of money. Number 4. Non-cash consideration. If XYZ Electronics receive non-cash consideration such as goods, services, or shares, they need to determine the fair value of that consideration and include it in the transaction price. Example: if a customer offers XYZ Electronics shares in this startup as part of the payment, XYZ Electronics would need to determine the fair value of those shares and include it in the transaction price. Number 5. Constraints on variable consideration. IFRS 15 imposes constraints on recognizing variable considerations. It should only be included in the transaction price if it's highly probable that there won't be a significant reversal in the future. This means that XYZ Electronics should be reasonably certain that the variable consideration will not have to be reversed later. Why is step 3 important? Determine the transaction price is essential as it forms the basis for recognizing revenue from the contract. Accurate calculation of the transaction price ensures that revenue is recognized in a way that reflects the consideration expected to be received. It also helps address uncertainties related to variable consideration. In summary, step 3 involves calculating the transaction price, which may include fixed and variable considerations, adjusting for time value of money and non-cash consideration, and considering constraints to ensure revenue recognition is realistic and reliable. Properly determining the transaction price is crucial for accurate revenue recognition under IFRS 15.